Welcome back to the afternoon session of the December 10th, 2024 Investor Advisory Committee meeting. Adam or Andrew, do we need to note if any IEC members have joined or departed as we return to the public session this afternoon?
Yes, I will note that James Andrus has joined the afternoon session and that George Georgiev joined the morning session, is currently present. And it looks as if Christina Martin Fervita is not currently present, nor is Nancy Lemond.
Okay. Our afternoon agenda begins with our panel on the mainstreaming of alternative assets to retail investors. This panel is by Andrew Park, followed by a discussion of a potential committee recommendation later this afternoon. The panel that we now will begin, mainstreaming alternative assets to retail investors, will run until 4 o'clock. Andrew?
Thank you, Brian. So our next panel is titled The Mainstreaming of Alternative Assets for Retail Investors. And so following the IAC's panels back in September of 2023 that examined a similar but separate issue around accredited investors being able to invest directly in private market offerings, including ones offered under Regulation D, our panel today will focus separately on the implications of all retail investors potentially having access to non-traditional assets that can be purchased directly through their brokerage accounts or offered by investment advisors. And so for starters, what do we mean when we say alternative assets? And so for the purposes of this panel, alternative assets we're going to define them as non-traditional assets that are not stocks or bonds and can be something such as private equity, venture capital, commodities, and private real estate. And investors had traditionally been able to invest in such alternative assets through real estate investment trusts, both traded and non-traded, and as well as business development companies. But in recent years, we have increasingly seen more types of alternative assets being offered through different vehicles, such as interval funds and also exchange-traded funds. And so each of our panelists, who I will introduce shortly, will help the committee today think through the various benefits and potential issues with the wide swath of retail investors now having access to these alternative investments. We will first start by understanding the backdrop of just how public markets have changed in the past few decades. Then we will hear more about why companies are opting to stay private longer and understand the various drivers of growth in the private markets. After that, we will hear about the features of different types of funds that retail investors are interested in, especially when it comes to alternative assets, and how that's evolved over time, and how that all works when it comes to the Investment Company Act of 1940. After that, we will then discuss some more of our panelists about some of the issues when it comes to liquidity, which go beyond just the importance to investors in the funds, but also how they can serve as a reliable signaling mechanism to the broader market. We will also go into some of the issues around valuations and how discrepancies between different valuations can be resolved. And then we will also discuss the potential risks, including a sudden loss of capital for retail investors when it comes to investing in alternative assets. And so following the panel, we will then open it up to question and answer, where we will dig a lot deeper into a lot of these different issues. And so first, our first panelist is going to be Professor Neil Newman, who is a professor of law at Texas A&M University. And Professor Newman will talk to us a little bit about the public markets and how they have evolved in the past few decades, and help us start to think through why we are starting to see an interest in companies both staying private and also why we have seen the private markets continue to grow. So, Professor Newman, I'll turn it over to you.
Thank you, Andrew. I appreciate the introduction and the opportunity to address the committee. So are we going to put the presentation up?
Adam, can we get the slides up, please?
Beautiful. So Adam, I do have a lot of animation, so just I'll talk and you can flow with me. Um, so just getting right to the point with the next slide. Um, just a big takeaway, since we've got 7 minutes max, and most professors, it takes us 7 minutes just to clear our throat. So I really had to focus and dial in on my presentation and just get right to the point. So the big takeaway here is that retail investor demand we've seen an upward trend in retail investor demand for investment products, but at the same time, public equity options have been declining since 1996. So, the big focus of this panel is to think about what is the appropriate pivot, shift, or adjustment to accommodate this trend. Next slide, please, Adam. So, looking at some big market trends and starting with the biggest one on the next slide. From 1996 to 2024, 1996 public companies just topped over 8,000. As of 2024, that number is now at 3,700. So we've seen a 53% decrease in publicly listed companies. We see that companies are staying private longer. Some of them aren't going public at all. One of the things we see, and I think that'll be talked about in the other panels, is that they're finding um, adequate infusion of capital from private sources, and this allows them to avoid the regulatory burden that comes with being a publicly traded company. So all these trends have led to a significant decline in the publicly listed companies that are available for public investment. Next slide, please. So when we look at the public equity markets as a whole, the market cap in 2004 was 17 trillion. That number is now topping in the second quarter of 2024 of 55 trillion. And then when we look even more in depth, like we said, there's 3,700 total publicly traded companies. However, the top 500 of those companies comprise 87% of that market cap. And then it's even more concentrated still, with the top 15% of the top 500 companies composed of Apple and Microsoft. So we've seen an increased concentration in the public equity markets. Next slide, please. At the same time, when we look at mutual funds, which is the primary vehicle for retail investors, in 2005, we saw 8,400 funds available. We see that number has decreased, although not significantly, but we do see a decrease to in 2024, we got 6,816 mutual funds. So roughly a 20% decrease from 2005. When we look specifically at the retirement market, we can see another trend, noticing in 2005, that retirement market was right around 14.4 trillion. And that portion of that retirement market what I'm trying to show here is, for example, you see in 2005, we've got 50% of that market consists of defined contribution plans and individual retirement plans. Those are primarily the self-directed plans that retail investors invoke and manage their own retirement. So about 50% of the retirement market was the case in 2005. When we looked at 2024, with the $40 trillion in assets, that self-directed component has gone up to 64%. So retail investors are continually taking a more active role in managing their retirement accounts. Next slide, please, Adam. So looking at public versus private equity historically, if we're looking at the big question of this move to from public equity to private equity, I think this is useful information. So, right, a lot of information on this slide. So the blue line is private equity and historical performance from 2005 to 2023. And the yellow line is public equity over that same period of time. And so these are historical performances over that period of time. So what we see is private equity has performed just as well, if not better, than public equity. And also noteworthy, if you look at the circled portion noted as financial crisis, right? That was around the 2008. We can see that that public equity is a lot more volatile in these times, where private equity tends to stay a little bit more less volatile, if you will. And then again, in around the 2019 to 2022 timeframe, the big event being the pandemic, of course. Again, we see public equity fluctuating a lot more so than private equity. Next slide, please. So just concluding, and I think I did pretty well with my 7 minutes. Some big takeaways. Public equity markets are much more concentrated, as we've seen. Fewer listed companies are present now. We have a high concentration of the stock market in the top handful of companies. So that has a bearing on diversity and the ability of retail investors to diversify. Investment options for retail investors are much less diversified than 15 years ago. Historically, private equity has performed on par, if not better, than public equity, and even more so during periods of volatility. So I think that's the segue that now may be the time to really explore making these alternative assets more available to retail investors. So that concludes my remarks, and I will pass the baton.
Thank you for that, Professor Newman. And so those are certainly very helpful figures. And next, we will hear from Melody Wang, who is a director and head of global private markets product commercialization strategy over at BlackRock. Melody is going to talk to us about what the drivers are between the growth of the private markets and talk to us a little bit more about why companies are opting to stay private. So Melody, I will turn it over to you.
Thank you. As Professor Neil Newman discussed, today's investors face a shrinking universe as investable opportunities when constrained by the public markets alone, as companies are staying private for longer, resulting in fewer IPOs and public equity options. On the other hand, private markets are playing an increased role in financing the economy, and the growth of private markets does not show any signs of slowing down. Total AUM across private markets is expected to reach 30 trillion by the early 2030s, up from 15 trillion last year, with fundraising surpassing global public market equity issuance each year since 2016. In private equity, 87% of US companies that have over 100 million of revenue are privately owned as of last year, representing a broad cross-section of the economy. In private credit, post-global financial crisis, banks retreated from lending and private credit stepped in to fill the void. The private credit market is now over 1.7 trillion, roughly the size of the high yield market, and we believe that the total private debt market could exceed 3.5 trillion in the next 5 years. Private markets can help investors pursue higher returns and income and offer diversification benefits to complement existing public market exposures. These investments have become a key building block for institutions like pension funds to generate sufficient long-term returns to meet their investment objectives. Retail wealth investors are expected to double their private markets allocations from 2.3 trillion in 2023 to 5.1 trillion by 2025, as they also seek similar benefits for their portfolios to meet their retirement goals. Those surveys find that financial advisors expect to increase allocations to private markets Most wealth investor portfolios are relatively underweight private markets, with only 10% of their portfolios allocated to alternative assets, compared with an institutional client like a family office, which holds about 39% on average. The difference between institutional and wealth exposure to private markets may reflect the challenges retail investors have historically faced when accessing and investing in the asset class, including large minimum investment sizes, limited availability of data, and higher operational burdens. Additionally, in the US, there are several vehicles which alternative asset managers are leveraging to structure private markets and make them accessible for retail clients. Whereas in Europe, they have standardized it with the European Long-Term Investment Fund, LTIF, structure across asset classes and regions. The LTIF market is expected to grow to approximately $100 billion in assets over the next 5 years, as the structure drives clarity and ease for investors and advisors through unified rules across client suitability, liquidity, and allocation thresholds for private markets access, and drives and supports client education. With the crucial role private markets play in financing the economy, it is important for wealth investors to access the market. However, the underlying instruments do have a different liquidity profile compared to public market alternatives. As we continue to provide access to these investments, data, liquidity, and valuations will continue to be key areas of focus and modernization to create quality products to meet our clients' investment objectives. Thank you.
Thank you, Melody. We'll next hear from Rajiv Chanda, who is a partner and head of the registered funds practice at Simpson Thacher. Rajiv will talk to us a little bit more about these various types of funds, fund structures, what retail investors are looking for when they are interested in allocating a part of their investments in these funds that are invested in alternative assets. And then also talk to us a little bit more about how the Investment Company Act of 1940 interacts with this. So, Rajiv?
Thank you. And I have slides.
We'll give it a moment for the slides to load, but there we go.
Perfect.
Go ahead.
Thanks, Andrew. So as you said, my name is Rajiv Chanda. I'm the head of the Registered Funds Group at Simpson Thacher and Bartlett, as well as the co-managing partner of the Washington, D.C. office of the firm. We have 75 lawyers at the firm, including 16 partners who focus solely on retail access to private markets. So this is a topic that is near and dear to us and at the heart of the services my colleagues and I provide to our clients. That said, the comments I'm making today are my views only and not necessarily the views of my partners, my law firm, or my clients. I'll say a few words today about the structural issues that retail investors desire and how the choice set available to those investors has and continues to evolve. I will focus on the limitations in the statute and the regulations that make access to high-quality private equity difficult for retail investors, and will end with some suggestions for the Commission to consider to alleviate those difficulties in a manner consistent with investor protection principles that are at the heart of the 1940 Act. So going to the next slide. I'll start by providing an overview of the structural features that retail investors want when accessing private markets. In understanding how retail products should be designed, I think it's important to start with an understanding of how private markets have traditionally been accessed by institutional investors. The traditional structure follows from the types of assets themselves, which are generally illiquid and hard to source, and from the nature of institutional investors who are managing large, complex investment portfolios, often for very long time horizons. So private funds are set up as drawdown structures to permit sponsors to call money only when a deal is imminent. At some point, the ability to draw the capital expires, meaning an investor's capital commitment may be unused if opportunities don't exist. Investors get their money back only when the underlying asset is sold, and there is an outside target date by which the sponsor will try to sell all of the assets and return the money. These funds are usually narrowly targeted in areas where sponsors have the greatest expertise, and investors are generally indifferent to tax reporting complexity, instead preferring maximized after-tax return. That's different because retail investors are human beings when we're talking about retail products, as opposed to large institutions. Typical private fund structures are not well aligned with the desires of individual investors. So you have to take the paradigm and change it to accommodate what human beings want. They want to invest their money right away and to know how much money they're investing, and to be able to get their money back when life happens, like death or divorce or tuition payments. In addition, because allocations to alternatives are a relatively small portion of one's investments, they want diversification and/or overperformance. And they want simplified tax reporting and are often willing to sacrifice some return to do so. So going to the next slide, I want to discuss how this impacts the product types available to retail investors. It means that the structures available to individual investors must balance the trade-off between the illiquidity of the underlying assets and the liquidity provided by the structure. As private market assets are illiquid, the more liquidity the structure seeks to provide at net asset value, the greater the chance of mismatch. The less liquid the structure, the less attractive it will be to investors who are human beings. This circle chart shows that trade-off. Each of these products offer their own pros and cons and have their own specific use cases depending on the desired strategy and target investor base. You could think of it as evolution, but really the better way to think about it is that different types of fund structures are in different parts of the illiquid asset, liquid structure trade-off cycle. And as a policy matter, regulators should not favor or disfavor any one structure over any other, and a robust set of choices for retail investors along these axes is preferable. So going to the next slide, I think one of the major issues that the Commission should seek to address is that regardless of the structural choices for retail funds, there's no suitable structure that provides retail investors with access to a direct private equity buyout strategy, which is in many ways the quintessential private market strategy. It is true and very positive that investors have gained significant access to PE through secondary strategies in registered fund wrappers. Even this has been limited to accredited investors by an SEC staff position of unknown provenance. But for direct private equity, registered fund regulations are incompatible with the strategy. More specifically, what I mean by that is that in an ideal world, retail investors would have access to PE through high-quality sponsors who have a track record of success with the sophisticated institutional investor community, meaning a sponsor's existing private funds would share deals and invest side by side with a retail registered PE fund. But the problem is that under current co-investment relief, a sponsor can make a side-by-side investment into a private asset, but it's not clear what it can do with the asset after it has made that investment. That is because the 1940 Act treats the acquired portfolio company as an affiliate, it limits transactions with that company itself. In some cases, it may even limit the ability of a sponsor to put more assets into a portfolio company it has purchased. It's also unclear if a sponsor can provide services to the company for a fee. Providing needed services to a company in order to turn it around is a hallmark of private equity. And in particular, the most successful private equity managers who differentiate themselves based in part on the business expertise they can provide to portfolio companies. Cutting off that ability deprives registered fund investors of the true value add of PE. Also, the regulations do not permit performance-based fees for most types of registered funds sold to retail investors, even though that is how incentives are usually aligned between investors and sponsors in other parts of the investing world. So the upshot is this. Even if sponsors were able to offer direct PE to retail investors, the sponsors that are most successful in attracting institutional capital are disinclined from providing retail access to direct private equity under current regulations. The risk, if this is left unchanged, is that you will have high-quality sponsors focusing more on creating unregistered products for the ultra-high net worth channel, while subscale sponsors with no track record of success seek to peddle their products to retail investors. So turning to the last slide, what can the Commission do about this? Simply put, we need to modernize the ability of registered funds to invest in private markets. We need to allow registered funds to invest in affiliated private funds or invest in deals and provide services to turn around companies in which they invest. And we need to align the incentives of sponsors with the funds they manage. In other words, we need to fix those hurdles that I just went through. But investor protection principles are the heart of the 1940 Act, and the rules and regulations should be carefully crafted with this in mind. Any exemptive order of the SEC that the SEC grants, which is how I would recommend we begin this process, needs to start by protecting the registered fund and the retail investors against overreaching affiliated transactions. In particular, I recommend that the Commission permit sponsors to be granted exemptive orders permitting registered funds to invest in affiliated underlying structures, so long as they, 1, prohibit multiple layers of fees charged by the same sponsor, 2, require arm's length negotiations for service arrangements with portfolio companies, and 3, require independent board approval for certain conflicted transactions. Until we recognize that retail investors deserve, desire, and can benefit from access to not just private market investments, but to the best sponsors in the private markets, we cannot truly claim to be democratizing access to private markets. The reforms I'm suggesting would go a long way towards making that a reality. I'd like to thank the subcommittee for giving me the opportunity to present my views today.
Thank you for that, Rajiv. We'll next hear from Phil Buck, who is the Chief Executive Officer of Armada ETFs and an issuer of 2 ETFs that are invested in private real estate. Phil will discuss some more about some of the issues when it comes to valuations in the private markets and talk about how the liquid secondary market of funds that are invested in alts can also be very useful to the broader market. And given the fact that ETFs are one such product, this will be particularly very helpful for us to hear. So Phil, I will turn it over to you.
Thank you, Andrew. Thank you. Good afternoon. I'm very glad to be here. I want to express my gratitude to the Securities and Exchange Commission for the opportunity to speak as a part of this committee on the mainstreaming of alternative assets to retail investors. The effort made by the SEC to solicit feedback and diverse perspectives from market participants through opportunities for public comments, advisory committees, transparency of speeches and rulemaking orders is noticed, and it's appreciated throughout the market. So it's an honor and a privilege to contribute to this important dialogue. It was the most regulated of times. It was the least regulated of times. I was recently told by our medallion distributor representing FINRA rules that in a letter to our investors, I could not refer to one of our funds as unique. After much back and forth, it was decided that it would be allowed to use the word distinct. So for a regulated asset manager, the precise line between compliance and fraud was being drawn in between those words, unique and distinct. Around the same time, a cryptocurrency was launched, which has since gathered over $200 million of investor assets, a cryptocurrency called Fartcoin. Didn't know if I could do that with a straight face. And while I wouldn't dare challenge the intrinsic value or economic utility of a Fartcoin, I bring it up to contrast against the reality of a heavily regulated securities market. Investment professionals are not allowed to give public investment advice unless they add a disclaimer that their investment advice is not, while bad actors outside the industry promoting questionable ideas are now left unchallenged. And this is the result of the letter of the law taking priority over the spirit of the law. The fact is that we are living in an age of financial nihilism, where the zeitgeist promotes gambling and recklessness, and where risk-taking is being rewarded by markets and prudence punished. With this backdrop, we are here to talk about private assets being mainstream to retail investors. With this backdrop, the topic is sure to be met with skepticism. I've been writing about this topic for a couple of years now, and I constantly receive feedback from people concerned that this is another scheme to stick retail with dubious assets. However, my comments were prepared as a way to address the very issues that concern those same people in a positive and a proactive way. The goal here is not to throw hard-to-value assets at an unprepared public, but to bring sunlight into corners of the markets that currently get no light at all. So it's critical to establish this fact up front. Valuations of private assets are not reliable. I recently published a detailed analysis of the leading private REIT fund. Using publicly traded comparables, we found that the performance divergence from public markets to be as high as 30%. How could such a large divergence in valuations occur? Well, that fund's prospectus told us exactly how. I quote from the prospectus. NAV calculations are not governed by governmental or independent securities, financial or accounting rules or standards. The methods used to calculate our NAV are not prescribed by the rules of the SEC or any other regulatory agency. Further, there are no accounting rules or standards that prescribe which components should be used in calculating NAV, and our NAV is not audited by our independent registered public accounting firm. We calculate and publish NAV solely for the purposes of establishing the price at which we sell and repurchase shares of our common stock, and you should not view our NAV as a measure of our historical or future financial condition or performance. Well, this NAV, it should be noted, has been the basis of more than $5 billion in fees charged by that fund at that NAV. So is it any surprise that we found it to be inflated? That NAV has also been repeatedly used as evidence of performance and outperformance of the fund versus public market competitors. But the issues of how the performance of private assets is represented extends beyond returns. Volatility of private assets is perhaps the greater distortion. Private equity marketers have long used the infrequent marks relative to public markets to calculate standard deviation, volatility, Sharpe ratios, and related calculations, and either assert directly or imply that there's less risk than their public market counterparts. This is both dangerous and deceptive. The leverage embedded in many private equity investments makes them more, not less, more risky than the public markets. Yet we often see them marketed to risk-averse investors with those metrics cited. The liquidity premium that would historically be associated with more liquid assets has turned into an illiquidity premium, selling on the perception of exclusivity. As Cliff Asness wrote, the illiquidity was once implicitly acknowledged appropriately as a bug, but are now clearly sold as a feature. Still, I come here today not to complain about the state of markets, but to praise them and to provide a solution. The public markets are a modern miracle. The US stock exchanges now trade more than 10 billion shares per day, and they trade with low latency and stunning connectivity. The NYSE processes over 1.5 million quotes per second at trading peaks. On June 28, 2024, during the Russell Index reconstitution, NASDAQ executed almost 3 billion shares, over $95 billion in notional value, in 0.878 seconds. The miracle of public markets is not just in the volume and the speed of trades. Those trades happen at the best prices anywhere on the planet because the fundamental mechanics of the market won't allow you to buy above the lowest offer or sell below the highest bid. And of course, the miracle extends to the regulation of the public markets overseen by the SEC. One of the few issues that we do have in public markets is that there are too few securities listed. The Wilshire 5000 is down to just 3,400 companies. There are fewer public companies today than there were 30 years ago. Why is this the case? Well, one reason might be the regulatory burden of maintaining a public security. Bank of America estimates that the cost of regulatory compliance and governance of a public stock is $8 to $10 million per year. If the regulatory burden can be eased to allow private assets to be brought onto public markets, I believe it'll lead to price discovery of those private assets where liquidity is best, which is the public market stock exchanges. Exchange-traded funds are currently unable to hold private assets outside of a small illiquid bucket allowance. If that restriction was lifted, ETFs would be one way that price discovery could happen on exchanges and out in the open. There's concern that public markets would be unable to price the securities, but precedent says otherwise. In March 2011, for example, the Egyptian exchange was closed during a period of political instability in Egypt. Despite the closure, ETFs such as the VanEck Egypt Index ETF continued to trade, and global price discovery moved from Egypt to the US stock markets, where investors could access that investment exposure and vote on valuation in real time with real dollars. Similarly, in June 2015, the Athens Stock Exchange was shut down for more than a month as part of Greece's financial crisis, and the Global X MSCI Greece ETF continued to trade on the US stock market. In fact, ETFs that track foreign exposure in different time zones trade every single day during US market hours, providing price discovery and liquidity for the entire global market on US market exchanges. If we allowed private assets to benefit from the same opportunity for price discovery, liquidity, valuations would be determined by the point at which buyers and sellers meet, with buyers naturally incentivized to pay the lowest possible price, sellers naturally incentivized to get the highest possible price, and liquidity providers incentivized to connect them and to close any arbitrage gap. It's a beautiful system, and it works in real time every day. Issues of trust and transparency of data reported by private assets must be addressed ahead of any public market solution. I would submit that there are new technologies being built now that will address those issues. Those solutions include innovations such as third-party real-time data validation utilizing AI and blockchain reporting, which can introduce efficiencies in addition to increasing trust. In other words, innovation is the answer. As Hester Pierce wrote in February 2020, investors are well served when innovation flourishes. Quote, I recognize that innovation involves risk, but it is investors who should get to choose the winners and losers of the market. Regulators should not impede investor choice. Rather, they should ensure that investors have access to accurate disclosures about the range of available products, including their risks. Bringing private assets onto public markets brings their valuations into the open, determined not from inside a closed office, but determined by the public on open exchanges, and it would lead to a wave of innovation in the asset management industry and likely lower fees and better liquidity for investors. So thank you again for the opportunity to share my thoughts.
Thank you, Phil. And we will next hear from Craig McCann, who is a principal and owner of SLCG Economic Consulting. Craig will talk to us a little bit more about some of the issues that arise with private market assets, especially continuing Phil's comments about valuation and also the importance of liquidity. So Craig, I'll turn it over to you.
Thank you, Andrew. Thank you for inviting me to share my thoughts. It's an honor to participate on this panel with such great panelists who I've come to admire and respect a great deal. I thought it was good going fifth, but I realize now it's hard to follow Neil, Melody, Rajeep, and Phil. But let me do my best to make 2 points and offer one suggestion. The first point is that the term alternative investments is used too broadly from my perspective because it obscures critical variations in the investments. Innovative products which efficiently package previously unavailable underlying economic exposures may benefit investors by offering greater diversification. Investor advocates should cheer the development of products that increase risk-adjusted returns for all investors, including retail investors. And firms like BlackRock, Apollo, KKR, Carlyle, and others, with their sophisticated leaders, staff, and counsel, and decades-long experience, may be able to bring such diversifying investments to retail investors. But unfortunately, the term alternative investments is also used by promoters of commonplace investments presented in illiquid and unnecessarily costly wrappers that clearly harm investors. Examples from the last 20 years include oil and gas and equipment leasing DPPs and non-traded REITs, for which there are traded vehicles with the same underlying exposures. These alternative versions of traded investments only added illiquidity to mask their high costs and conflicts of interest. Non-traded REITs in particular warrant further comment. Non-traded REITs added nothing to the diversification benefits of traded REITs, which have been around since the 1960s. I believe the first traded REIT was listed in 1965. Rebranding these high-cost illiquid products as alternative investments makes for good marketing. Published academic research, though, shows that investors earn 6% per year less on average in non-traded REITs than in traded REITs. Now, I've contributed to some of that literature, but it's not Craig McCann publishing that literature. Peer-reviewed literature from academics mining the same data reached the same results. And it's not a surprising result since non-traded REITs compete in the same property markets as traded REITs. Only non-traded REIT investors incur much higher offering costs and ongoing annual costs. Well, after the demise of so-called lifestyle non-traded REITs, a new variant of REITs, NAV REITs, emerged. This is the product that Phil was speaking about a minute ago, the leading example of which grew to $70 billion in assets. The REITs, the trade association, and marketing firms argued that these NAV REITs could deliver returns that were less volatile than traded REITs and less correlated with the stock and bond markets while providing some measure of liquidity to investors. These claims were and are based on model-based net asset values used to calculate highly smooth monthly returns and liquidity only when you don't need it. While non-traded REITs have faded, sales of non-traded BDCs have increased dramatically in the last couple of years. This latest generation of non-traded BDCs will follow the same pattern as non-traded NAV REITs have. Non-traded BDCs compete in the same market for securitized loans as traded BDCs. And if I may pause on this for just a second, because I think it's so critical. As I was thinking about this, I asked my staff here to compare the holdings of a non-traded BDC and a traded BDC from the same asset manager. Believe it or not, 98% of the holdings of the non-traded BDC overlapped with the holdings of the traded BDC. And the traded BDC's holdings overlapped 88% with the non-traded BDC. And the part of their portfolios that were not overlapping were all similar interest in secured loans, paying SOFR plus a spread, 6.5, or 7%. So the non-traded BDC and the traded BDC from the same asset manager were identical underlying products. Only one of them was illiquid. And you could wonder why that would be a useful feature. As Phil said, a feature rather than a bug of these products. My second point is that liquidity is not just about retail investors' ability to sell an investment. Trading disciplines management. The market for corporate control, which was the topic of a lot of my graduate research 40 years ago, benefits from the ability of investors, activist investors in particular, to be able to accumulate shares and replace management. That's not possible in an illiquid, non-traded vehicle, and it explains how some of the inefficiencies in those vehicles can survive. Liquidity, also the trading that results generates price discovery that helps regulators like the SEC and others determine whether, and investors for that matter, whether a company is failing or not. The suggestion I would like to make, I know I only have about a minute left, is that that not any particular product or product type be prohibited, but you focus on what would be adequate disclosure for the type of products that are being sold. That is, I suggest that you carefully consider what constitutes truthful disclosure for these products. As Phil was saying, issuers contract with trade associations, brokers, and promoters, which then tout the low volatility and low correlation with stocks and bonds to argue that investors should put some of their portfolio in these non-traded products. Let me just give you one example. The largest of the NAV REITs had received a lot of publicity. We applied standard academic techniques to unsmoothing their monthly returns, and the volatility of their returns, correctly calculated, is 3 times the volatility that you get from just taking a standard deviation of their monthly returns, and the Sharpe ratios dropped by 2/3. So consistent with the Division of Corporation Finance's guidance to non-traded REITs in 2011, when an issuer or a party that an issuer contracts with touts the low volatility or low correlations of its investments, of the product it's selling, the issuer should also include cautionary language that these volatilities and correlations are not being calculated with market prices, based on market prices, and that unsmoothed returns would be much more volatile. Thank you again, Andrew, and thank you for the invitation.
Thank you, Craig. And finally, we will hear a little bit more about some of the issues around valuations, as well as some of the other investor protection concerns from Professor Ben Edwards. Professor Edwards is a professor of law at the William S. Boyd School of Law at the University of Las Vegas. Professor Edwards?
Good afternoon, and thank you, Andrew, and thank you to the committee. As customary, I note that my views are my own as a law professor at the Boyd School of Law. Given the ground already covered, I will share a different view. I think about today's issue both as an academic and as someone who has represented investors hurt by alternative investments. Here, I pause to stress that the vast alternative investment category includes products issued both by reputable firms and by scoundrels. My skepticism about some complex, costly, and risky alternatives comes from my time running investor clinics. I led clinics at Michigan State and at UNLV. We helped investors harmed by substandard advice from financial advisors. Usually, the bad advice came from a financial advisor selling some alternative investment. This is representative experience. A 2021 report from the North American Securities Administrators Association also confirms that complex, costly, and risky products routinely appear in investor complaints and state enforcement actions. But my experiences are not unique. I serve on the board of the Public Investor Advocate Bar Association, a national organization dedicated to representing investors. The cases PIABA members take often differ from clinic cases only in the scale of damages. If you lose $20,000 from an unsuitable alternative investment, the small cadre of remaining investor clinics offers your best hope. Our approach to alternatives will affect the demand for investor representation. If the worst alternatives enter retail portfolios, investors will need help. As you think about how to manage mainstreaming alternative investments, I suggest targeting alternatives distributed by brokerages in exchange for transaction-based compensation. Consider non-traded real estate investment trusts. We saw many cases with these products. Ordinary people do not decide on their own to go buy these. Rather, many non-traded REITs were designed to be sold to unsophisticated savers. In our cases, non-traded REITs usually charged over 13% in upfront fees and cost for the privilege of purchasing them. After that, the REIT's management companies extracted another percentage or two annually. Unsurprisingly, many non-traded REITs significantly underperformed publicly traded REITs. An analysis from Craig McCann and others found that non-traded REITs' average annual returns were 6.3% compared to 11.6% in a traded REIT portfolio. One financial advisor described what an honest sales pitch would sound like. This is it. If you invest $100,000, I will be paid a commission of $7,000. My firm is going to get $1,500 to $2,000 in revenue share. My wholesaler, the salesman that works for the investment sponsor company, will get $1,000. He's a great guy, buys me dinner all the time, and takes me golfing. The sponsor company is going to get around $3,000 to pay for some of the cost incurred in setting up the investment. So all in on day one, there'll be around $87,000 left over to actually invest. I bet you're getting excited. This description still leaves things out. Investors were not told that they should expect this overpriced junk to underperform against public REITs that they could buy for free. It doesn't even mention the liquidity problems. Many of you know this history. As it looks forward, the committee should distill lessons from past problems with broker-sold alternatives. Here are things to keep in mind. First, do not expect retail investors to read traditional disclosures. In every non-traded REIT I saw, the REIT itself plainly disclosed that it was a terrible investment. One expressly disclosed that for multiple years, the distributions it paid investors were just investor capital getting returned. When this happens without disclosure, we call it a Ponzi scheme. Many retail investors generally do not read offering documents because they rely on their financial advisor to protect their interest. If you want to protect retail investors, you need to think beyond issuer disclosure. Of course, this does not mean you should abandon traditional disclosure. Disclosure matters in regulatory responses and for holding people accountable for selling improper alternatives. Second, financial advisors getting paid to sell a product are not likely to faithfully communicate the true merits and risks of an offering. Their firms will also not survive liability. Earlier, I gave you an honest version of a non-traded REIT sales pitch. This is not what happens when financial advisors actually sell these products. When our clients came to us, none of them ever understood the cost, fees, or commissions at the time they agreed to the transaction. None of them understood that they could get access to a better performing publicly traded REIT simply by buying them on the open market. Now, you may not worry about the sales pitches involved in distributing the products on the theory that investors harmed by broker-sold alternatives can recover losses in FINRA arbitration. I would encourage the committee not to rely on ex post liability because the worst alternatives will be sold by the worst brokerage firms. Often these uninsured firms close when liability arrives, leaving investors without options. The third lesson you should distill is that account statement values matter. When non-traded REITs emerged, they were often sold at $10 per share. As no shares traded, account statements used the sales price to value the investment. Yet, what were these shares worth? One non-traded REIT put it this way in a risk factor, stating, "Our board of directors arbitrarily determined the price of the shares, and such price bears no relationship to our book or asset values or to any other established criteria for valuing outstanding shares. Because the offering price was not based on any independent valuation, the offering price may not be indicative of the proceeds that you would receive upon liquidation." Obviously, you don't create 13% in economic value by burning 13% in costs and commissions. There was no clear value. Non-traded REIT management didn't even calculate their NAV until 18 months after an offering. Yet retail investors saw $10 a share on their statements and thought their investments were worth that much. Values somewhat tethered to reality showed up much later when, after 18 months, some new value appeared on account statements. This let financial advisors ply their trade without retail investors realizing how much they had paid. If the market rose, increased share value camouflaged losses to commissions, fees, and conflicts. If the share value decreased, financial advisors blamed market conditions. In 2016, a new FINRA rule changed how brokerage firms had to value non-traded REITs on account statements. After the new rule, brokerage firms that sold non-traded REITs for $10 a share suddenly had to display a value that accounted for the fees and commissions. It changed market practice. One broker with Cetera even told a financial reporter that he would no longer sell the products because he didn't want to have clients ever saying, "Oh yeah, by the way, how come this is $88,000 instead of $100,000?" The committee should pay close attention to how brokerage firms communicate alternative asset valuations to retail investors. If efficient markets do not value alternative investments, account statements need to reflect the uncertainty. And there are many ways to play games with alternative investments and valuation. What should a retail investor see on their account statement when a mutual fund holds liquid shares in startups or other private companies? As Jeff Schwartz has recognized, there is significant incentive for funds to massage the reported valuations of alternatives because higher values let you collect higher fees and court more investors. Value here may be unknowable. Mutual funds have a long history of assigning different values when they own the same private investments. Take the way funds valued investments in Uber before it went public. In June of 2015, BlackRock valued its stake at $40.02 a share. Hartford Financial Services had its stake at $35.67. Fidelity claims its shares are worth $33.32. Who was right? Who knows? They're probably all wrong. Consider Uber again. Once Uber had a private market valuation of around $76 billion. In 2019, months after the IPO, the public market cap sat at around $49 billion. The untested private market valuation did not hold up. Retail investors should receive statements that reflect the true uncertainty with alternatives value. When it came to valuing Uber's shares, stated values fell in a range. Yet ordinary retail investors receive account statements with clear numbers that hide the range of uncertainty around alternative asset valuation. Instead of communicating a false clarity, account statements should communicate the true cloud of uncertainty to retail investors. Valuation remains a problem even when functioning markets provide liquidity and an illusion of value. Take cryptocurrencies as an example. Many digital assets have existing market values, but should retail account statements reflect only those values? Consider the caution it might inspire if account statements listed liquidation value alongside the market value for alternative investments like Dogecoin. Last week, Dogecoin reached 44 cents a coin. If you owned all the Dogecoin in the world, you would not have anything of value other than the ability to sell the useless digital asset to someone else. Dogecoin isn't like copper, silver, or gold because the real economy does not use Dogecoin to produce goods. Ultimately, alternative investments have more uncertainty in their valuations, and retail investors need to have that uncertainty communicated to them in a way they actually hear. Burying it in lengthy disclosure documents ensures that retail investors will not alert to the issue. They will order their lives secure in a false belief that their alternative assets are actually worth their stated values. Putting valuation uncertainty directly on account statements would meaningfully inform retail investors. If retail investors are sophisticated enough to be sold alternative assets, they're sophisticated enough to be told the truth about uncertain valuations. With that, I thank the committee again for the opportunity to speak.
And I want to thank all our panelists again for giving us many insightful thoughts to really think about here. And so I wanted to now open this panel up for discussion. And so our panelists gave us a lot to think about here in order to help us focus our conversation and dive deeper into them. I thought I would segment them into some different pieces. And so I would ask my fellow committee members, we will first dive into some of the issues around liquidity. And so to the extent that you have any questions, if you could either raise your hand or put your question in the chat. And then after we discuss that, we will then touch upon many of the issues that were raised around valuations. And then following that, go into some of the questions around fees, truthful disclosure, and also suitability before we spend the final minutes of this panel then discussing some more about some of the recommendations that we just heard. And so going into starting with liquidity here, one of the areas of concern really is that a number of you had mentioned product liquidity, especially in some of these funds. There have been issues, especially recently. There have been headlines on, for example, some commercial real estate funds where there has been either gating or prorated redemption. And so we've heard, a couple times about the liquidity issues around these funds. How I would ask, maybe Ben, Phil, or Craig initially, how should retail investors, how should disclosure work when it comes to these sort of issues around not being able to redeem, especially when we're talking about older and retired investors who may be relying on a certain time frame to receive distributions and have certain liabilities that they are also trying to meet as well. Is there any way that we can improve either how investors understand these inherently illiquid types of funds, or is there any other way that they can be made aware of this, right? I mean, acknowledging the fact that there are the concerns about, do investors read these disclosures? So I'll initially turn it over to either Ben, Phil, or Craig, and if anyone else wants to weigh in.
Okay, well, I'll jump in first. So I want to echo that your traditional securities disclosures are not useful for retail investors. In my view, account statements are one of the few documents that they're much more likely to be looking at and to watch. Putting something on there that would illustrate the limitations on liquidity will be important. So one of the challenges is often the need to redeem. If there's some larger economic event in the United States, you're not going to have regular orderly withdrawals. People are going to try to all withdraw at once, and they're just not going to be able to do it. And I think we need to make sure that retail investors know that if they're being sold these assets.
And if I may add to that, Phil and I were both referring to a large NAV REIT, the largest of the NAV REITs, and that's the one that famously started limiting redemptions about 2 years ago now. And liquidity risk is something that people don't often understand as a systemic risk. It's not individualized, really. We think about it in individual situations where you want to put a down payment on a house or put a child through college, individual circumstances. But it turns out that at least the literature says that the liquidity risk that's being compensated for potentially in returns is related to the overall market returns. And so in the case of that large NAV REIT, when did people want out? People wanted out whenever commercial real estate values dropped. So it was a market condition that prompted the run on that REIT. And so to the extent that illiquid investment is touting its liquidity based on normal market conditions where it hasn't gated redemptions in a very long time, perhaps 2 years, 3 years, 4 years, it should still disclose the fact that it may in fact limit redemptions, and it's likely to limit redemptions exactly when you would like to get your money out.
I will turn it over to Paul Roy, who I see has his hand up.
Yeah, thank you, Andrew. And thank you to our panelists. Great points, great discussion. I'd like to shift over to the registered investment company space. And I think this question really is more for Rajiv and Melody. The drafters of the 40 Act, really did focus on the fact that there needed to be vehicles for less liquid assets. And I'm talking about closed-end funds. Rajiv, on your chart, you have interval funds, you have tender offer funds that are available. And my question is, what can be done to sort of enhance these products, which are really designed to offer retail investors less liquid investments? And so, thinking about the fact that my understanding, there's been very few new closed-end fund listings in the last few years. Are there steps that can be taken to make closed-end funds more viable? Are there provisions that could enhance interval fund offerings or tender offer fund offerings? My understanding is that when you create an interval fund, you have to go into the SEC, you have to provide, ask for exemptive relief if you want to offer multiple classes of shares. Rajiv, you mentioned the staff kind of fiat that you can't invest more than 15% in a private fund unless you only sell to accredited investors, which is nowhere in the Investment Company Act. It's a staff position. And, those funds don't have some of the flexibilities that open-end funds have in terms of series fund relief and that kind of thing. So I'm wondering if you see opportunities to enhance the viability of these vehicles that are really designed to give retail investors access to private and alternative investments that are less liquid.
Yeah, so thanks, Paul, for the question. Nice to see you again. I think you're right. I think you've hit on a number of roadblocks or things that sort of get in the way of some of these products. And fundamentally, I agree with you that you start from the premise that the framers of the 1940 Act said there's essentially two types of vehicles. There is a vehicle where you can get your money back on demand, and there's a vehicle where you cannot get your money back on demand. And it follows that the point of that was to allow a better match between the liquidity of the underlying assets and the liquidity expected by investors. And so, to the point that some of the other panelists made, I think it is important, the education for people to understand that doesn't mean that the liquidity is going to be there whenever you need it, because there might be others who want it at the same time. That education is crucially important. But the flip side of that, or the understanding has to be, it's because of that limited liquidity that you're able to access that. So I think there is effectively a question of, is it a good idea to have those types of products? I think wealth investors have uniformly said yes. And from the commission's perspective, I think once that's the case, that people want that kind of access, want the ability to transact at NAV and not at a listed price, because NAV is fundamentally the best way to prevent dilution. Ex ante, if everybody is coming in at the same price and going out at the same price, you do not have someone getting more shares than they should or fewer shares than they should for the price they're paying. There's lots of different things that stop those products from being as effective or as efficient as they could be. So for example, in addition, I agree with you, multiple classes of shares, having to get a exemptive order for something that is now cut and paste and routine seems unnecessary and increases the burdens, the private fund limitations. But I would also add to that flexibility around the interval, right? Like I think having some understanding that there may be times where actually it's in the best interest of the fund to further limit the interval or to give preference to people who have died or people who have small lots, some of which is already built in. or people are getting divorced, to allow people liquidity in certain human type events in a way that is less rigid, I think could be effective as well. Ultimately, the premise of your question, I think, is somewhat that the rules and regulations are inefficient for those types of products, and I agree with that.
Thank you.
I would just add that as we consider launching new products, we do look across the entire range of wrappers when researching new products to ensure that we're ultimately providing our clients with quality products to meet their investment objectives, and ultimately are mindful to ensure that the attributes of the vehicle, for example, liquidity, are appropriate for the characteristics of the underlying portfolio. And as we've discussed in the past, like, key challenges continue to include data, liquidity, and valuations. And on the point that there are a number of different wrappers, it is something that we have to keep in mind as we continue to navigate across all the different access vehicles, as there isn't one unified framework to consider giving access to these private market deals, which might have similar characteristics at the end.
Thank you.
And to follow up on that discussion about, just the various different types of wrappers out there, I mean, we covered a very wide spectrum of, when we talk about alternative assets, right, ranging from the non-traded REITs to the ETFs. And so I want to try to focus now on a little bit more about some of the ETFs and some of the more liquid secondary vehicles. And hearing both what Phil and Craig had mentioned about not the benefit of liquidity, not only for the investors in the funds themselves, but also about the valuable price signals that we can that the broader market can get from them. Can either of you talk a little bit more about just how liquid the publicly listed vehicles right now of a number of alternative asset funds are currently, and how you envision that may change in the coming years? And any thoughts on kind of what liquidity is now and what it may look like going forward?
Yeah, we can look at public private equity companies. You can look at REITs. You can look at different alternative assets and see robust market in the secondary in the public markets. I'd say, in fact, there is a dearth of available instruments that allocators in the public markets can use to get access to alternatives, and they're looking for even more options. But when you take a look at some of the assets that have been made liquid through either public ETFs or different things, different CLO instruments, other instruments, those instruments themselves have been made more liquid once a robust secondary market was established on the public exchanges. So it has increased not only the liquidity of the assets, but the underlying assets embedded in those funds. Frontier Markets is another good example of that. Ultimately, liquidity tends to follow flows. So if the right, alternative or private equity products are listed and there is investor interest, the market makers have the ability to price in those securities within certain parameters, within certain risk models. But with the right market maker incentives and investor interest and flows, there will be ample liquidity.
Yes, if I could add, so we do see a lot of illiquid underlying investments being held through liquid vehicles. So, for instance, I believe the 100 largest actively managed stock mutual funds hold $30 billion of traded REITs. The last time I checked, they hold 0 non-traded REITs, not a share. And so the fact that the underlying holdings, the commercial real estate or assisted living facilities or leisure properties are illiquid doesn't mean that the wrapper itself has to be illiquid. And it doesn't mean that investors don't have access to those underlying exposures. Just to extend that thought another minute, I would say, think about the shares of Coca-Cola. Those shares are liquid, even though Coca-Cola's intellectual property rights are not liquid, and its real properties are not liquid. Same thing with REITs. You've got the same underlying illiquid real estate held by traded REITs and by non-traded REITs. And so while private market equity or private equity can be thought of as illiquid. It doesn't mean necessarily anyway, that investors' holdings need to be illiquid in order to access private equity. I'm not a lawyer or have the experience that Phil and Melody have, so I can't say, fully give you all of my thoughts on that in an informed way. But I can say that the connection between the liquidity of the underlying assets and the liquidity of the investors' share in those assets is not a function of the underlying assets. It's really only a function of whether investors trade those shares amongst themselves or only trade them back with the issuer of the shares. If they're only going to be trading the shares back to the issuers of the shares, then there is a connection between the liquidity of the underlying holdings and the liquidity of the investor's interest in those holdings. Otherwise, I think they're completely orthogonal. I think they're completely independent.
Andrew, could I also respond to that?
Yes, please.
So, I mean, I think if I might disagree a little bit, public markets as price discovery, I agree they play a very valuable role. And I think they play a particularly valuable role when we're talking about single assets or companies, and what that means. But when we're talking about a basket of securities or investments, the public markets also represent, in addition to the value of the underlying assets, investor sentiment, supply, demand, broad market views, and not necessarily the value of the underlying investments. The investors who are purchasing these assets as part of their retirement and long-term savings plans are generally better off transacting at the actual intrinsic value of those assets. Now, it might be that there's some disagreement as to what that value is, or that valuation is more of an art than a science. But ultimately, a basket of securities where you add up the values of the various assets and transact at the same price going in and going out, such that no one is being diluted at the expense of other shareholders, is what ex ante, I believe, most retail investors want. I don't think it should ultimately be a choice between NAV traded vehicles versus listed vehicles. I think both of those have a role to play and a way of being able to both increase price discovery and give investor choice. But I think I object to the idea that public listing prices are always necessarily better than a NAV-based mechanism.
And I think this transitions then naturally to some of the issues then, because Rajiv, you mentioned, right, this notion of intrinsic value, and we've heard from the other panelists about what some of those discrepancies can look like for both illiquid assets, and also in the case of what Professor Edwards had raised, even when you have shares of he mentioned, gave the example of private shares of Uber. And just kind of the discrepancies there. So the question, I would ask all of you is, we've heard about the various problems and challenges around it. What are the potential solutions then when it comes to, kind of establishing an intrinsic valuation that that investors and others find very fair? So I'll ask kind of two pieces of that. Should the sponsors of the fund or the fund advisor be allowed to self-value NAV? Or alternatively, if you think that there should be an independent valuation agent or an appraiser, what specific type of role should that appraiser have to ensure that they are truly independent? So I'll open that question to all our panelists.
Okay, well, I'll jump in here. And so my view is with products where there isn't a clear market value established by liquid efficient markets, it may make more sense to show the value to retail investors in a range as opposed to giving them a hard number. Because what you need to communicate is that there's a degree of uncertainty around that valuation. And I don't think that is necessarily happening now. When it comes to whether or not the issuer should conduct its own valuation, I tend to think that the agency cost risks there are quite high, and it may make sense to have an independent valuation. Of course, there's a trade-off here that when you do the independent valuation, it's going to increase the cost of conducting the valuation. So we have to be thoughtful about that as well.
Yeah, I mean, I would add that, I think a lot of the particular issues that have been raised on this panel relate to non-registered funds. Registered funds do have quite a bit of board oversight and only self-value within relatively narrow circumstances, and routinely use third parties to help validate pricing on an independent basis. I think the products that are not registered by the most sophisticated sponsors are following the same playbook. And I think to the extent they're saying NAV is not determined by, any governmental rule or agency or things like that, it's because they have to say that, because it's for a registered fund, there is a formula. For other funds, even the ones that follow the most robust mechanisms, you have to let people know that there is not, in fact, a mandated formula. I'm not saying that means that there ought to be necessarily a mandated formula, but I do think people are using independent valuation agents a lot, and I think having clearer disclosure about how that's done could go a long way towards easing some of these concerns.
Yeah, I would submit not only the disclosure. I mean, you can't expect retail to become forensic accountants on this stuff. You got to remove the conflicts of interest. That's pretty much the basics. And if you're charging fees, at the assets of the fund, which are determined by the NAV, and you're not allowing people to sell to the NAV, that's a pretty clear conflict of interest. It's pretty glaring, in fact.
One other issue that has come up with some of these funds is also an increasing reliance on various non-GAAP type of figures, especially when it comes to a certain amount of performance reporting. There have been issues that have been raised about how there is not a standardization of performance reporting that, for example, could allow one type of fund, especially since we mentioned several different types of funds out there, right? There's no apples to apples type of comparisons there. And so, if we look for one type of one example of a non-GAAP figure, you have some funds that increasingly have been utilizing this structure known as payment in kind, or often referred to as PIK, where payments, including interest payments, get deferred and instead are paid through the issuance of additional debt, right? And so, payments in additional debt, I'm sure most investors would say is not comparable to a cash-on-cash distribution in another fund. So, any thoughts from you all about, just because you talked about, right, this how to make better disclosures, right, in order to address this issue. Any thoughts as to how funds could either have more standardized type of reporting, so that especially the funds that rely on these non-GAAP figures, there is a way that investors who, right, as you mentioned, they're not going to do forensic accounting into how performance and NAV is calculated. Are there other ways that there can be a simpler, easier way for investors to make a comparison between one fund and another, especially when we're talking about vastly different amounts of liquid exposure in them? So a question again to all our panelists, but I'll start maybe by asking either Craig or Ben on this.
Yeah, so if I may, I alluded to some work we did previously on the NAV REITs, and they publish monthly NAVs and monthly distributions, and from that, on their websites, publish historical returns, year-to-date percentage returns, 1 year, 3 years, 5 years, and since inception. Then sponsors, trade associations, and marketing firms use that data to calculate statistics that are commonly used in the investment management industry, Sharpe ratios in particular, to determine whether an investment is providing an adequate risk-adjusted return. And then in a more complicated fashion, dropping those returns into what we call a mean variance optimizer to determine whether you should have some of this investment in your portfolio. The concern I raised earlier kind of was that the way these returns are being calculated by appraisal, by committee, by, in the case of that NAV REIT DCF model, leads to smoothed returns, which understates the standard deviations and overstates the Sharpe ratios and overstates the argument for including these in an investor's portfolio. To the extent an issuer is publishing that data, which Phil is exactly right. The Form 10-K filed with the SEC says this NAV cannot be used to calculate performance, and then they report performance on their websites using that NAV. So setting that issue aside, if a firm is going to publish returns based on that net asset value, and they're going to tout, or if their agents are going to tout the smoothness of those returns, there ought to be a really healthy qualification on there. And even better yet, the returns should be unsmoothed. There's standard techniques created by academics around the country. And in the case of that particular REIT, if you unsmooth the returns, the actual underlying economic returns are 3 times as great as the monthly returns they post. So I think that having some qualification on any posting of returns that are based on these model-based NAVs would be a huge help to investors.
Anyone else with any other thoughts on potential improvements to performance reporting, or any suggestions as to other metrics, which I know is it's a very challenging topic to wrap our heads around. And I guess I'll ask then one other follow-up question to this is, given all these issues that we've just now heard about on the valuations, and still the challenges that we still face on just kind of establishing again this notion of intrinsic value, and what kind of an apples to apples comparison is. That there's been a proposal, speaking of the Investment Company Act, that is proposed, and I know that this is the guidance that has mentioned going from allowing closed-end funds to go from 15% in illiquid assets, and this is in reference to Rule 22E4, 15% to potentially 100% of the fund's net asset value in these illiquid assets. So just kind of given these issues that we've just been discussing, and the complexity and the challenges around that, what gives us assurance that if that figure were to be changed, given the proposals out there, that we would not be magnifying these types of challenges even more for investors if we go from 15% to the entirety of the fund. I guess any thoughts either from Rajiv or anyone else on this panel?
Sure, I'm happy to start, Andrew. So I think just so we're talking about the same thing, and so everyone's on the same page. So there's an SEC staff position that says you can't invest in underlying funds more than 15%, and unless if you do, you have to limit it to accredited investors. And there's been talk about getting rid of that limitation. Is that just making sure that, Andrew, that's what you're asking about?
That's right. Yes.
So I guess I would start from so from a illiquidity perspective, what we're talking about is just whether or not you can have the illiquid assets underlying a registered fund be other funds, as opposed to other non-fund assets. So you already could have 100% illiquid assets in a closed-end fund, for example, commercial real estate or liquid or private credit, just as long as you're not doing it through a fund structure. So I think, like, fundamentally, the question to me is diversified access to private equity something that retail investors should also have, in addition to diversified access to real estate and credit, which they already have. So the rule is uniquely designed to penalize private equity as an asset class for individual investors. So I understand you're asking about valuation and not about the rule itself. From a valuation perspective, I think the typical structure where you would see this is where you have an investor investing in other sponsors' private equity products. There is inherently going to be a lag when you're dealing with those kinds of investments because you're waiting for information from the other sponsor, but you also are getting the best possible information. So ultimately, I think the types of structures that should be encouraged in those types of assets really should be longer dated types of investments, the tender offer kind of structure, where the capital that you put in is tied up for longer, because otherwise you have the possibility of people coming in and out and taking advantage of price swings, which when you're dealing with something that's always on a little bit of a lag, could happen. So I think that's probably the biggest difference if that rule were to go away.
I'd like to weigh in on this one. So when we're talking about this raising the cap, I guess, on the 15% and allowing funds to increase investment in liquid assets, I do have some concerns about that situation. I think we need to take into consideration the behavior of a lot of retail investors. They tend to tolerate less holding periods. They tend to want to get in and out of assets much more quickly. So we have funds when we have a lot less liquidity. I think we run into an issue or challenge when it comes to appropriately accommodating retail investors and just how they tend to move in and out of investments. So you have that competing tension if you start going in that direction and increasing the amount of illiquid assets. I think you run into that issue.
So let's now talk about some more about some of the questions around both suitability and also going back some more to diving some more into how to present information effectively to retail investors. And so I see that we have a question in the chat from Christine Lazaro, who has a question about both Reg BI and suitability. So Christine.
Thank you. And thank you for this discussion. So I wanted to just ask about, and this is likely starting with Ben, the role of financial advisors in this space, and in particular, what role Reg BI might play in helping protect retail investors, but also your experience in terms of whether financial advisors are capable of fully understanding these products to be able to make an informed recommendation to customers.
Okay, so that's excellent question, and I think one of the things we have to know is when we talk about retail investor demand for these products or retail investor interest, It has not been my experience that retail investors themselves are going out and thinking, oh, golly, I would really like to add some alternative assets to my portfolio. These are products that are overwhelmingly sold to retail investors by their financial advisors. And so, Reg BI plays an important role here because it's supposed to constrain the ability of the brokerage firm to to give retail investors or to place assets in retail investor portfolios that are not really appropriate for them in amounts that expose them to too much risk. One of the major challenges here is that many financial advisors don't seem to understand any of the numbers beyond how much they're going to be paid in a commission. And so if you have a financial advisor that doesn't necessarily understand the risks and the structure of the product, they're not going to be able to explain it well, to the retail investor. And so Reg BI, I think, plays an important role here. It provides some constraint, but these are products that are overwhelmingly recommended and sold to retail investors. These are not things that retail investors decide usually on their own to go acquire.
And then I see we have a question from James Andrus.
So thank you all very much. I've enjoyed the panel. I am a member of CalPERS, and at CalPERS, basically, they do all of the investing, but basically, it provides me the opportunity to benefit from participating in a number of different asset classes, including private assets. Shouldn't that same opportunity be available for workers who are not a part of a defined benefit plan? And when we think about that, shouldn't we allow for the rules to allow for investors to make these alternative assets a part of what they're able to invest in? What are your general thoughts?
And if I could also add to that question too, to James's question, one question I would have for panelists as well is, as we're talking about retail investors going into alternative assets, when you're what percentage of their portfolio do you envision we're talking about, right? Are we talking about some investors who want to go 100% in alternative assets, or to James's question, are you seeing that investors are kind of expressing interest for like a 1 to 5% type of like diversification to their portfolios? So just I guess question on to James's question on kind of following what institutional investors get, but also understanding, right, what is the interest from retail investors in terms of how much they want to be invested in this. So I'll kind of open it up to panelists here.
Okay, so I'll start. So my view here is that for retail investors, one of the things we have to be really laser focused on are whether the alternative investments they're getting are the result of adverse selection. We don't help retail investors by allowing them to take the worst bets that more sophisticated institutional investors and smart money has already walked away from. So if there are structures or ways that retail investors can invest alongside institutional capital and groups like CalPERS and others and defined benefit plans, that makes sense. And I would even support those retail access points charging a somewhat higher fee to retail investors because of the higher costs associated with administering a retail plan. The challenge is drawing a line that makes sense between alternative assets that are targeting retail investors because of their unsophistication and alternative assets that are able to more productively deploy retail capital at scale alongside institutional capital. And so when I think about what percentage of a portfolio might be appropriate, I tend to think it's very small. But what I have seen, representing investors, is that the investors who have problems do not have a small percentage of their portfolio allocated to alternatives or other unusual investments. It is chock full of alternatives that their financial advisor has selected for them.
Yeah, Ben and I are are in agreement here that the real key is to make sure that the most sophisticated and best sponsors, the ones that CalPERS can get access to, are the ones that individual investors get access to as well. And I think we really do have a problem right now because there's, people, the numbers that, that we've talked about in terms of $40 trillion and the 401k and all these other access points where there's so much money. And so people are looking at it. And if you have the most sophisticated sponsors, the ones who are raising plenty of money from institutions, sitting out this opportunity because the regulations make it inefficient or worse for them to give access to retail investors, I think we will have that kind of adverse selection. I think if you could have the right types of allocations available, I think when you think about the allocation to alternatives, people often talk about the world moving from 60-40 to 60-30-10. But I think really the right way to think about it is even that 60, if the 60 is equity, if you want access to the broad US economy or the broad global economy, as the public markets have gotten smaller, that 60 needs to have some private markets access as well. The 30, the fixed income access, as people have moved away from bonds and gone to private credit, as banks have moved away from the markets as well, that private credit piece of it needs to be in that 30. So you can imagine those numbers getting high up just from not because somebody's selling something to someone that they don't need or don't want, but because that is actually the best way to get a broadly diversified portfolio with access to the global economy that will help you retire. And so the question, I think, from a policy perspective comes back to who's going to provide that access? What are the opportunities that retail investors are going to get? Or will they just be stuck with a smaller and smaller portion of the market, the public, the remaining market that is public on the debt and equity side, or go after things like Fartcoin or things like that because that's what's being made available to them.
If I could add, please, Andrew, I agree completely with Ben and Rajiv. I didn't mean in any way to sound negative about the opportunities to develop products that improve the risk-adjusted returns of retail investors. We should all cheer that. And it may well be that there's some mechanism for investing alongside institutional investors like CalPERS to achieve the benefits of private equity that Rajiv was just talking about. My comments really earlier was just that the term alternative investments or private equity will be hijacked to cover investments that are clearly detrimental to investors and in the long run detrimental to the higher quality firms like BlackRock and KKR and Carlyle and Apollo, who do want to deliver the best diversifying investments available to whatever source of capital there is, whether that's institutional investors like CalPERS or people's 401k plans. And somehow I hope the SEC will be able to always keep that distinction in mind, what I think of as legitimate investments from the more problematic investments that maybe Ben and I have been overly exposed to in our careers.
I'll add one more to the chorus in favor of individual investor access to alternatives and to private equity. The diversification benefits of investing broad market in the US are diminishing pretty rapidly. 7 stocks now make up 1/3 of the weight of the entire S&P 500. The correlations of the companies within the stock market are increasing, and the number of public companies is, of course, as a reference before, diminishing. So, any opportunity to give people uncorrelated or lower correlated assets, with all the other issues that have been brought up today, being solved as best as possible, but net giving more investors more access to more diversification and less correlated investments is a net good for everybody.
So we have a question from Paul Roy.
Yeah, thanks, Andrew. I guess I'm a little frustrated because I keep hearing folks saying that retail investors don't have access to private alternative investments, and they do. And the question in my mind is, what's the appropriate structure for that access? And again, I think the Investment Company Act of 1940 and registered funds provide a lot of protections for retail investors when they invest through those registered products. And we talked about interval funds and tender offer funds, and I think those are mechanisms, going to James's question as to how a retail investor can have the same exposure to assets that somebody in CalPERS has. But I guess I do have a question, and this is for Melody, which is, you mentioned the European model, those funds that facilitate less liquid investments or investing in vehicles with less liquid investments. Is there any learning we can take from your experience with those European models that we should think about from the standpoint of regulation in the US of these products?
So I would say the EU introduced the LTIF structure back in 2015 to provide a consistent framework to making these sorts of long-term investments in private assets available across all EU member states. Now, that is somewhat different, right, from our own regulation, where we all are operating under US regulatory reform. And so their goal was ultimately to widen access to a broader set of clients, including individual investors, with that initial adoption. And the consistent framework, I would say, makes it a lot easier for clients to access private markets and investors to provide access to these private markets, as a single set of rules reduce variation and thus complexity. If you think in comparison where we currently operate, there are a number of different funds, REITs, BDCs, to your point, interval funds, which do provide access today, but there are varying characteristics across all of them. For example, client eligibility and liquidity, despite the underlying characteristics of the private market assets and strategies might be similar. And so as we think about potential reform, is there space for more of a unified framework similar to what the EU has done in order to streamline some of these variations?
Thank you.
I might, I agree with that, Melody, and I would note that in Europe, you can still some people are still doing UCI Part 2s, and some people are still doing RAFEs. And so there's still sort of a choice of structure depending on exactly what you're trying to accomplish. And so I agree that, Paul, with the underlying premise and with Melody's answer, that like the registered fund has been disfavored in a way that I think is unfortunate in the US. And we've seen other structures come up, often for more wealthy individuals than true retail investors, which is what you kind of have in Europe for the wealthier, like the RAFE, it's for the wealthier investors, for example. And so I think the reason I think, Paul, we say there's less retail access to private markets is because if it's retail means a human being, there's lots of access. If retail means anybody who wants to get some access to the broad US economy through private markets, it really, you start at least at accredited investor and are often higher than that, a qualified client or qualified purchaser, in terms of these types of access products.
One of the issues that has come up that Ben had mentioned was this notion of how a number of alternative assets are being sold, not bought, but sold from investment advisors to retail investors. My question, in following a separate panel that we had previously held on the IAC, was, how do we think about the rise of self-directed investors who may be reading about these types of investment opportunities, or as James Andrews had asked before, see that in a separate context, like, for example, that retirement plans, the defined contribution plans have a different level of allocations to private market investments. So, one of the questions that comes up is, we talked about disclosures. Any thoughts as to how, what role the SEC can play to make sure that investors have a proper way to understand what exactly are they buying? What is there a central place that you think this could all exist that investors could go to learn, what are the types of products out there? What are the different features that may more closely align with what they're looking for versus what they would be adverse to? And anything else just on, any simple ways to get get the most important information to investors about what they're going to buy, assuming that they're not going to dig through prospectuses and not go through and try to reverse engineer how various metrics are established. Any thoughts from the panelists there on central resources for investor education, and any other thoughts on disclosure for self-directed investors?
And Andrew, just for clarification, are you talking about in the context of retirement plans or
I'll
general
say for both,
investing?
right? Either in your brokerage accounts or in your IRAs, right? For self-directed investors.
Okay.
Okay, well, I'll jump in here. So I think about a lot of investor education a little bit like pollution. And so it used to be that the US government would tell sources of toxic emissions how they had to abate emissions. Now we've gone to a different system where we tell industry, you need to get it to this level, and we don't really care how you do it. Is it a smokestack scrubber? Is it clean coal? Whatever. So one solution to this that I don't think has really been looked at is, instead of you having a very prescriptive approach where you'll give a form CRS to everyone. What I would rather do is have the SEC go and audit select groups of clients to see how well they actually understand what's going on. And the idea here would be that you would regulate brokerage firms or advisors or others based on how well they were accomplishing the goal of achieving some retail investor education in the clients that they serve, as opposed to being prescriptive and telling them exactly how to do it. Because I think the approach is this is a very hard question. I don't have great answers to it other than trying to really laser in on that goal and ensuring that it's actually being achieved.
I'm gonna share some thoughts, and so feel free to push back. When we're talking about a quote unquote retail investor, um, I can run the gamut from very sophisticated experience to just someone who opened up a Robinhood account and just started trading. Um, we've seen recently that when left to their own devices, these quote unquote retail investors can really um, be disruptive to themselves and to the market. Um, I'm thinking about the GameStop short sale, that whole thing that went on. And so I get, without rambling, so others can weigh in. Anything that, if we're talking about the combination of retail investor access um, and trying to protect them, then I think you really have to think about sort of sort of readily imposed guardrails versus trying to rely on retail investors as a whole taking steps to protect themselves, I guess, for lack of a better term. I just think as a whole, they will behave in a way that um, won't be ideal for protecting themselves. So there's got to be insulation to protect them as a whole. Otherwise, my feeling is they will not always, and as a whole, will probably do things that are not in their best interests. But feel free to push back. That's just from what I've seen, from what I've heard in this discussion, some of the points have been made. It just seems to be the case. To rely on them to protect themselves, to get educated, to make the certain decisions, I just don't know if we can count on that happening as a whole. But feel free to push back.
anyone else with any
Well-
other thoughts on self-directed investors?
Yeah, I won't. It's me again, Andrew. This is not a pushback. I mean, again, I'll reiterate my point that in terms of giving investors access to these types of investments, if they can go through a registered 40 Act regulated funds that has various protections built in, independent directors, oversight, valuation rules and requirements. I think that's a responsible way for investors to get access to these types of investments.
So I'll jump in here with a quick story. I got a call from a local person here in Las Vegas who had somehow managed to on his own decide to invest all his assets in a particular leveraged ETF that was a bet against market volatility. When market volatility showed up, his account incinerated. And so after that, I had to tell him, buddy, I can't help you. Nobody asked you to do this. Nobody recommended this to you. You decided to do this all entirely on your own. He then proceeded to call my dean and the provost and demand that they make me help him. And I had to tell him again, I cannot help you, sir. There's nothing I can do here. And so we think about this, the percentage of self-directed people that go out and do this that are going to get hurt are going to be there. And we have to consider like how to balance the harm that's going to fall on those people, against the benefits of allowing free access to an open market.
Craig, you have your hand up.
Yes, if I could please just agree completely with Mr. Roy that and to bring in one more piece of data. We've been talking about illiquid private equity and private debt. Well, there's been $6 trillion of Reg D securities issued in the last 3 years, $2 trillion a year. It dwarfs what we're talking about here today largely. And if you wanted to have investors have access to those investments through something like a 40 Act fund would be sort of the ideal way to do it, because there would be some professional oversight of the selection and management of those investments. And we could have a lot more faith that retail investors were being well served by those investments rather than making them directly in the Reg D offerings. So I don't understand the limitations on those sorts of investments in 40 Act funds, but it would seem to me that to the extent lifting those restrictions or reducing them would remove the incentive for some firms to sell them directly to investors. That would seem to me to be a really good thing for investors.
And seeing that we only have a few more minutes left now, I will turn it over to any remaining recommendations that our panelists have now for the SEC on how to address this. I mean, one thing that has become very clear from the course of this conversation is that it's clear when we're talking about the alternative assets and being available to retail investors, we're talking about a very wide and disparate set of investments, right? Whether we're talking about these types of Reg D offerings, right? Kinds of offerings that are sold directly to retail versus these registered funds that are traded over brokerages and operating a little bit differently. So one thing that's very clear from this conversation is that the committee will certainly have its work cut out for us in trying to make sure we narrow kind of exactly, kind of what, make a very clear distinction between these various types of issues and, potentially have recommendations that address them more piecemeal versus necessarily having a universal solution for all of these different types of products and assets. Because also, I think points have also been heard about how retail investors also vary significantly in their sophistication and their understanding of the market. Some who may have worked at institutions, while others have literally just opened up accounts and are just kind of going off of what they've maybe heard from friends, families, or potentially some financial influencers. And so in our last few minutes, I will open it up to panelists. You had talked about some of the suggestions in how the Investment Company Act, for example, of 1940 can be changed to reflect right the kind of the structure of these illiquid assets and how that can maybe potentially encourage more of an investment opportunity there. In our last few minutes, does anyone else, do our panelists have any other recommendations for for our committee, either on valuations, liquidity, or around any other guardrails to make sure that investors are not either A, accidentally being purchasing something they don't understand, or B, at risk of being put into an investment that is not suitable for them. So in our last few minutes, I will open it up for any other thoughts there.
So Ben Edwards here again. I'll jump in. My view again is that if we're going to push more of these assets into retail investor portfolios, we need to make sure we communicate with retail investors in a way that they actually understand. And so you want to make sure that they're aware, on their account statements or some other way, about the range of uncertainty that may exist around some kind of alternative asset valuation, and that they're also very aware of any constraints that may happen if they want to liquidate that asset. Those concerns are, I think, critically important. They're trying to plan and order their lives, and if they just look at a number and they think they can trust it, that's where they get into a lot of trouble.
If I could add, I think my recommendation ultimately was and is, and I think a lot of the panelists agree, that a registered fund wrapper for access to private markets that's chaperoned by intermediaries potentially, but certainly managed by a fiduciary, overseen by a board, is the best structure for retail access to private markets. The SEC's twin missions of capital formation and investor protection are very important. I do not think there will be a one-size-fits-all approach here, and I encourage the Commission to use what it has done in the past. When you think about ETFs, or you think about multiple share classes or other things that the SEC has done in the past, where they've worked with individual sponsors to address and balance these interests through exemptions that allow particular products to go forward, and then over time to move towards rulemaking that might actually be beneficial across the industry, as opposed to starting from rulemaking, because I think that it's a very complicated question with lots of different ways of balancing the various interests.
Okay, well, this has certainly been a very thoughtful discussion that will lead us lots to think about, especially as we really try to narrow down, again, just how to think about this issue with such disparate assets and investors. So I want to thank all our panelists for their insights today. I'd like to thank Neil, Melody, Rajiv, Ben, Craig, and Phil for their time and their insights, and I'm sure that we will follow up with many more questions. So with that, Brian, I will turn it back over to you.
Thank you, Andrew. That wraps up the Q&A. I want to again thank the panelists, our participants, for sharing such informative and engaging insights. We're now going to turn to our recommendation. We're discussing a recommendation of investors, their interactions with what are known as finfluencers. And that discussion will be led by Christine Lazaro and Paul Roy.
Thank you. I'm going to let Paul take the lead on presenting the recommendation.
Okay. Thank you, Christine. Thank you, Mr. Chairman. I'm pleased to present the recommendations of the Disclosure Subcommittee regarding the protection of investors in their interactions with finfluencers. As a result of the COVID-19 pandemic in 2020, the GameStop trading frenzy in 2021, and the aggressive promotion of cryptocurrencies, many young investors turn to investing as a means to generate income or create wealth. These investors grew up using technology to communicate and connect with one another, and therefore gravitated towards social media for investment information. The FINRA Investor Education Foundation found that 60% of investors younger than 30 were getting investment information from social media. Studies have shown that investors of color are more likely than white investors to rely on social media for investment advice. Because of their familiarity with gaming, many of these investors facilitated their investing through popular trading apps, which offered commission-free trading. These apps simplified investing with easy-to-use interfaces coupled with game-like features. This allowed for the so-called democratization of investing, as many new investors became involved in the stock market. These new investors sought out information on how to invest their money and turned to social media platforms such as YouTube, TikTok, and Instagram to obtain it. This has led to the rise of financial influencers, or so-called finfluencers. Because of their popularity or cultural status, finfluencers have the capability to influence the financial decision-making process of their followers through promotions or recommendations on social media. Finfluencers seek to influence potential investors by providing posts or videos with the hope that the post or video will be shared with other potential investors. You can find videos of some finfluencers flaunting wads of cash, expensive cars and houses, and screenshots purportedly showing large profits from options, securities, and cryptocurrency trading. But there is also finfluencer content that focuses on investment basics, mutual fund investing, personal finance, how to manage credit card debt, IRAs, and 401ks. This information can be engaging and provide useful financial education and promote financial literacy. Some finfluencers provide broad financial advice, and others provide advice on specific security investing. Finfluencers consist of former and current financial professionals, amateur investors and analysts who are self-taught, celebrities and athletes with no investment experience, and members of various affinity groups. These finfluencers can target particular groups of investors, such as young or older investors, women, members of minority groups, and immigrant communities. Now, some financial firms are also hiring finfluencers, including celebrities, to engage with potential investors. And studies have shown that investors tend to trust and act on celebrity endorsements more so than non-celebrity endorsements because of their familiarity with the endorsers. And the reach of a popular finfluencer can be significant, reaching millions of followers. Now, these finfluencers have several ways of making money, which can generate substantial compensation. They can receive revenue from social media platforms, negotiate affiliate contracts that pay commissions if viewers click links or buy recommended products, receive compensation from a corporate sponsor, or receive payments from followers who buy exclusive content such as courses, books, or other products or services. Unfortunately, content that promises immediate wealth and promotes risky trading strategies with potential for higher returns generates the most followers and viewers, translating into higher revenues for the finfluencers. A recent study by researchers at the University of California, Berkeley found that after tracking data for more than 29,000 finfluencers on the social media platform X, that the finfluencers who provided the worst advice were the most active and had the greatest following. So accordingly, it's difficult for investors to differentiate good advice from bad advice on social media. Moreover, corporate sponsorships and the promotion of specific securities can lead to conflicts with providing sound investment advice. Some influencers promote strategies that are inappropriate for many investors. Moreover, because the advice is general in nature and is not tailored to a particular investor's situation, it may be inappropriate for certain investors. And because of low barriers to entry, social media platforms are also unfortunately populated with bad actors and influencers, failing to disclose conflicts of interest, as has been reflected in regulatory enforcement actions by the SEC and FINRA. Back in June of this year, the IAC hosted a panel discussion to explore the growing impact of influencers and whether the existing regulatory framework is sufficient to protect investors. The panel provided insights as to why many, particularly newer investors, are turning to social media for investment advice, the types of influencers, the nature and content of their investment advice and financial incentives. The red flags and risks to investors of relying on social media for investment advice were highlighted, along with abuses and recent enforcement actions involving finfluencers and securities firms utilizing finfluencers to promote their services. A specific focus was on whether existing securities laws and regulations are sufficient to protect investors in their interactions with finfluencers. The SEC and other regulators have become increasingly concerned about the growing popularity and risks of social media as a vehicle for investment advice. The SEC, FINRA, and the North American Securities Administration have all issued alerts to investors about the risks of relying on social media for investment advice. And again, regulators have been aggressive in enforcing laws addressing violations by finfluencers. Now, existing federal securities laws cover some of the worst and problematic finfluencer activity. Anti-touting provisions apply when a finfluencer does not disclose that she has been paid by an issuer, dealer, or underwriter to promote a security. Anti-manipulation provisions have applied when finfluencers are engaged in pump and dump schemes. Disclosure and other requirements apply when an investment advisor or broker-dealer uses testimonials or endorsements by finfluencers. However, federal securities laws do not require disclosures by finfluencers if they are compensated by other than issuers of securities, such as by a social media platform, or require disclosure of various conflicts of interest or qualifications to give advice. We note that regulators around the world are concerned with the investor protection challenges that finfluencers present, and that a number of countries have taken actions to address concerns regarding finfluencers. Our subcommittee believes that the SEC should also consider taking additional actions to enhance the regulatory framework and protect investors in their interactions with finfluencers. We believe that regulators should adapt and evolve their policies and regulations to keep pace with technological advances and emerging risks to maintain credibility of the system and integrity of our markets. So our subcommittee suggests that the IAC make the following recommendations to the SEC, including that the SEC consider proposing a rule requiring basic disclosures related to finfluencers providing advice regarding securities. This would include disclosures of conflicts of interest, compensation received, regulatory status or qualifications to give advice, and the impersonal nature of such advice. Now, this rule would apply to finfluencers who meet the definition of investment advisor under the Advisors Act, whether they are registered or not. And these are finfluencers who can't rely on the publisher's exclusion in the Advisors Act. Now, this rule would pick up a subset of finfluencers and not cover those who are providing investment education and generalized financial advice. We think it's important to note that any person meeting the definition of investment advisor, whether registered or not, is subject to the anti-fraud provisions of the Advisors Act, which has been interpreted by the courts and the SEC to impose a fiduciary duty on advisors. This fiduciary duty, which includes the duty of loyalty, requires advisors to make full and fair disclosure of conflicts of interest. The rule we suggest is consistent with this disclosure obligation that applies to all investment advisors. We also suggest that the SEC issue guidance related to finfluencer activity that implicates the federal securities laws. And this would facilitate understanding of the applicability of the federal securities laws by finfluencers and hopefully avoid violations of those laws. We also suggest that data be published related to finfluencer misconduct, coordinating with the FTC, FINRA, and state securities regulators. We suggest that investment advisors use best practices when engaging finfluencers under the Advisors Act marketing rule. We suggest that the SEC encourage broker-dealers and investment advisors to train finfluencers that they utilize to avoid prohibited conduct. We also suggest that the SEC and FINRA continue to provide investor education focused on red flags and risks of relying on finfluencer advice. We also encourage the SEC to urge traditional investment advisors to enhance their outreach and education, particularly to newer investors who look to social media for advice. And we also believe there are opportunities for the SEC to work with other regulators and stakeholders to improve investor protections in connection with finfluencer activity, working with the Federal Trade Commission, international regulators, and social media platforms as outlined in our recommendations. I wanted to note that the International Organization of Securities Commissions, or IOSCO, recently released its consultation report on finfluencers. The report suggests actions for regulators to consider, and we are pleased that many of our recommendations are reflected in the IOSCO report. Now, I wanted to take a minute to just respond to some of the questions that Commissioner Peirce raised in her remarks this morning. She asked whether or not there were gaps that needed to be filled. And I think in our recommendation, we identify an area where we think there is a gap, that in a situation where a finfluencer meets the definition of investment advisor and can't rely on the publisher's exclusion, that we think that there's some basic disclosures that ought to be made regarding conflicts, compensation received, their qualifications to give advice, and the fact that the advice is impersonal. We think this will help investors make informed decisions about whether or not they want to rely on finfluencer advice. She also asked whether we were requiring registration of finfluencers, and the answer is no. In some jurisdictions, they have actually moved to require finfluencers to register with the regulatory agency in those countries. We didn't view that as necessary at this point in time. Again, our major approach was promoting disclosure so that investors can make informed decisions. She also asked about our recommendation regarding social media platforms. Our recommendation was simply to engage with them and understand how they're monitoring finfluencer activity. Our goal is not to engage in censorship, impede free speech, but just to understand how these social media platforms are interacting with these finfluencers. So with that, Mr. Chairman, I'd be glad to take comments and respond to any questions.
I'd like to just add on behalf of the subcommittee, I really want to just underscore that the recommendation is not intended to create a new category of investment advisor. The recommendation really is intended to make it clear what the disclosure obligations are when the social media finfluencing activities cause an individual to come within the purview of the Investment Advisor Act. And recognizing that there are benefits to investors in terms of having access to and accessibility of investment advice, financial information, The recommendation really is an attempt to balance access, innovation, and investor protection. And so with that, we can open it up to the rest of the committee for questions and comments. And Paul can keep the queue.
So Christine, it's Brian. I'd like to ask a question about the specific text of the proposed rule. If someone could explain that, so I think it's very novel and interesting idea where you're proposing a rule regarding disclosures regarding influencer activity and providing investment advice. And I'd like to understand, the scope of the rule, and in particular, there is the last sentence which says proposed rule would cover investment advisors that use social media to provide investment advice, whether registered or not. So can elucidate, give a little more background on that?
Yeah, sure, Brian. Yeah, what we thought was that the commission could use this authority under Section 2064 of the Advisors Act to propose this disclosure rule. And again, you'll see that that section focuses on fraudulent or deceptive courses of conduct under the Advisors Act. And we use that to promote the disclosure. I mean, I think the analysis is sort of as follows. You have the definition of investment advisor, which essentially, provides that if someone's in the business of giving advice for compensation, advice regarding securities, they meet the definition of investment advisor. But however, there's an exclusion, the publisher's exclusion, that many rely on, that provides that if you're giving impersonal investment advice and that advice is disinterested, then you don't meet the definition of investment advisor. You're excluded from the definition of investment advisor. The problem with some of the subset of influencers is that the advice is not disinterested. They're receiving compensation to promote a security. And in some cases, unlike in the anti-touting provision, the compensation is not coming from the issuer or a dealer or underwriter of the security. It's coming from other sources. It could be coming from, we're aware of the fact that some firms are engaging third-party marketers or investor relations firms to go out and engage a influencer to promote a security. It takes them outside of the investment advisor's definition and outside of the publisher's exclusion, and therefore they are investment advisors. And if you are an investment advisor, again, whether you're registered or not, there's a fiduciary duty that you're subject to and requires full and fair disclosure of conflicts of interest. And we think the rule that we propose is consistent with that.
Thank you.
Jennifer?
Thank you. I would say I have a number of concerns, many of which go to the same types of concerns that both Commissioners Peirce and Commissioners Ueda raised this morning. I'm happy to lay those out in more detail. I don't know what the appropriate time is for doing that here, but I wanted to ask a particular question about the kind of definition of compensation here. While you were kind of talking through the proposal, Paul, you mentioned compensation from social media platforms themselves as being something that would be disclosable. I'm kind of curious about where the boundaries are on that. It's a much broader concept of compensation than we would think about when we're thinking about kind of investment advisor compensation that I think you're referring to. And I just was wondering if you had more context to give.
Yeah, on that point, I think all we're doing is reflecting interpretations of the SEC on the term compensation that sits in the Investment Advisor Act definition of who an advisor is. And longstanding interpretations of the SEC has been that the compensation doesn't have to necessarily come from the advisory client. It can come from other sources. They broadly interpreted compensation to be an economic benefit that the person who is providing the advice is receiving. And so,
I'm sorry, is that economic benefit tied to the advice itself, though?
yeah,
Your receipt of compensation by a
these
social
people are,
media platform
yeah,
isn't
yeah, these
related
people
to
are in
the
the
content.
business of giving advice regarding securities. And therefore, whether or not the compensation comes from somebody who technically could be viewed as a viewer or a client, it's coming from the platforms. Again, you could have situations where somebody, firm has paid a third-party marketer or investor relations firm to provide compensation to the finfluencers or promote a particular security. I think under prior interpretations by the SEC, that could be viewed as compensation.
All right, and I would say I leave it to, I don't know what the kind of proper rules of order are for kind of me laying out further criticism. I just had that specific question that I wanted to get your take on.
Sure. Other questions?
Hey,
Comments?
yeah, Paul. Yeah, Paul. Hey, it's Craig here. I was just gonna, yeah, and I know how much work goes into all these. You guys have done a great job on putting this together. My question would just be generally on, kind of the ongoing monitoring and enforcement, given that many of these folks are unregistered. Are we confident that that the SEC is in position to deploy appropriate resources to to govern something like this? I guess is just be my kind of dumb question.
Well, no, it's not a dumb question, Craig, and thank you for the question. I think it would pose a challenge in terms of the SEC staying on top of compliance with the rule. But the hope would be that that folks would pay attention to the fact that this is out there. And again, part of one of our recommendations was the fact that we were concerned that many folks in this space really don't understand the parameters and how the federal securities laws actually applies to the activity. And so if you had that guidance plus this rule is in place, then hopefully you would get the attention of people who were would fall within the scope of the rule. But the SEC has a lot on its plate. But again, this is an effort to try to encourage more disclosure so that investors can make informed decisions. I assume if somebody calls to I think this may largely be a whistleblower type scenario where somebody calls the SEC's attention to focus on a particular finfluencer and how they're not complying with the rule. And then the SEC would be in a position to consider whether or not it wants to bring enforcement action.
Okay.
But it's a good question.
Thanks, Paul.
Other questions or comments? Christine, I can't see whether or not there are other folks with their hands up.
I don't see any hands.
I actually,
Go ahead. Alvin.
sorry, just a quick question. I came across a piece of research that just came out a couple of weeks ago by somebody actually at my institution here on fractional trading, fueling trading. Actually, the title of it was "Does Fractional Trading Fuel Meme Stock Frenzies and Bubbles?" From out of the Kelley School of Business here at Indiana, and it talked about how part of the meme stock frenzy and influencer problem ties to fractional trading. And I was wondering if there was any discussion, again, I saw this like not even a week ago, right? Was there any discussion about fractional trading and preparing the recommendation and how that could affect that
No,
part of the market?
yeah, I can say confidently, that was not a aspect of this that we focused on.
Okay.
Again, I think our focus was just observing that investors, particularly newer investors, are really gravitating towards social media, relying on it for advice, good or bad. Just were there things that we could suggest to the SEC that would somehow enhance investor protection, but we did not get into whether or not fractional trading. I mean, we did focus on the fact that you have commission-free trading, really allows for investors to be more active, and it, does have the effect of encouraging more participation in the securities markets, which is a good thing. The question is just how you're executing and who you're relying on for investment advice.
Thanks, Paul. I put it in the chat just so.
Yeah, thank you.
Yeah, and thanks. I thought it actually looked really good. Thanks for the work on it.
Jennifer, I just wanted to come back to you if there are no other questions. Jennifer, if there
Yes,
are no other
Brian.
questions, just wanted to give, because I know you wanted to follow up with those points.
Yeah, it doesn't look like there's any other questions. So I know that we're going to be moving to voting. I suppose this is a bit of a preview of where I'm going to vote, because I'm not in a position to be able to support portions of the recommendation, and I wanted to provide a little bit more of an explanation as to why not. I know a lot of work went into this, and I appreciated the work. I'm supportive of the recommendations in 3, 4, 5A, and 6. But I will not be able to support the recommendations for 1, 2, 5B, or 5C. I acknowledge the rise of the social media has led to a different channel through which potential investors may receive information about investing and other financial matters. And I share some of the concerns about the quality of information on social media. But the term finfluencer is defined here covers a wide range of people who are exercising their own rights to speak about financial matters, and in many instances are not regulated SEC broker-dealers or investment advisors. Although social media is a newer phenomenon, the Commission has confronted these issues before with the dissemination of information through print, radio, and television, and has created a set of rules that attempts to balance the rights of individuals to speak, the benefits of individuals of receiving information, even from non-regulated sources, and existing duties under the securities laws. And the recommendations that I'm unable to support, I don't think strike this appropriate balance in several respects. Most importantly, recommendation 1 suggests that the Commission adopt a rule under Section 206 of the Advisors Act to require specific disclosure of information by finfluencers, which is very hard to say. Requiring finfluencers, defined as a person providing, quote, advice about securities through social media, to provide a certain set of disclosures. This creates a form of mini ADV disclosure, but it's not clear from the recommendation how such disclosure should be made in a social media context. Is this information that must be included on every social media post or on someone's social media profile elsewhere? And these are not trivial questions, as the form of disclosure can have an impact on a content creator's ability to communicate with their audience. But moreover, the information required by the recommendation for such finfluencers, likely to be unregistered individuals, goes above and beyond in some respects what is required of disclosure by even registered advisors, requiring anyone providing advice about securities through social media to disclose broadly, quote, compensation received and their, quote, qualifications to give advice or lack thereof. It's unclear to me why the use of social media should result in a higher disclosure burden in some respects than those who are required to register with the Commission as investment advisors. The recommendation would also require a finfluencer to disclose the impersonal nature of the advice. Putting aside the fact that it should generally be obvious, as people who use social media are likely just as aware as people who watch television or read the newspaper, that the information being presented is not personalized, but being delivered to a broad and diverse audience. This raises important questions about the applicability of such rules to social media influencers at all by way of the publisher's exclusion. The recommendation, as Paul just noted as well, acknowledges that some finfluencers may argue that they are eligible for the exclusion. But in general, the recommendation fails to grasp that the social media model of influencing is regular posting for a general audience, key portions of the requirements for the publisher's exclusion. And to the extent that the finfluencer is not providing disinterested advice, the SEC's anti-touting rules may apply, potentially rendering the proposed disclosure recommendations relevant to a vanishingly small cohort. But even if the publisher's exclusion does not apply because a finfluencer isn't exactly the same as a newspaper publisher or a financial publication, the principles behind it, focused on the protections for speech under the First Amendment, are of paramount importance. Restrictions on the dissemination of information and affirmative requirements to speak can easily run afoul of the First Amendment, and the recommendations made here, focused on impersonal advice, which is often not subject to Advisor Act regulation without something more, runs a high risk of depressing free speech activity, with likely little corresponding benefit to investors who do not believe themselves to be receiving personalized advice from Instagram or the like. The same First Amendment concerns are repeated for me with respect to recommendation 5B, which asks the SEC to engage with social media platforms to understand their guidance to monitor problematic finfluencer activity. This recommendation is broadened by a definition of finfluencer that is not limited by Advisor Act definitions and presumably applies to any user of social media with some sort of significant following who may happen to speak about financial matters. It is not at all clear the limits of such a definition. Does it apply to individuals with a significant following who only occasionally post on financial matters? Does it apply to someone who themselves does not have a significant following but may post on a forum with a large participant group? Or someone who posts a comment on a post from a content creator who does have a large following? More fundamentally, what constitutes influence in this context? The recommendation itself that the SEC engage with social media platforms runs a high risk of resulting in a restriction on protected free speech. Such engagement should not be undertaken without a narrow focus and tight controls, neither of which are present in this particular recommendation. Recommendation 2 also suffers from the untenably broad definition of finfluencer in asking the SEC to work with other regulators to publish a database of finfluencer complaints and finfluencer violations. I am concerned with the potential for individuals who are engaging in no conduct regulated by securities laws to be ensnared by a federal database of allegations of impropriety about their social media posting related to financial matters. Finally, recommendation 1B regarding section 12 raises significant issues about the ability to share information about securities offerings online, potentially subjecting social media content creators who do not target a particular investor to make a solicitation for the security. This recommendation may have deleterious effects on the ability to disseminate information about an offering, particularly in the era of crowdfunding where offerings are often accessed online. Given the existence of liability under the other sections of the Securities Act for misstatements and other fraudulent behavior by content providers, the potential impact of Section 12 liability must be examined in a more wholesale fashion, including the impact on capital formation, not simply from the lens, as it is here, of increasing liability on finfluencers. That said, I am supportive of the recommendations that ask the SEC to provide further guidance to regulated individuals and entities about their own social media use, including their coordination with and retention of outside social media content providers. And I'm supportive of recommendations that ask the SEC for additional guidance to social media content providers themselves about whether their conduct falls within the federal securities laws and how they can comply with such laws. In addition, investor education is and remains a key component in giving investors the tools that they need to judge for themselves the quality of the information received from social media and other sources. And I'm supportive of recommendations here that encourage continued efforts to this end. Those are both welcomed and valuable. I say thank you for allowing me to kind of walk through where my views are on this particular recommendation, and thank you to the committee for the hard work on it. I am supportive of some aspects of it.
Jennifer, thank you for those remarks. Paul, Christine, thank you for the summary. Are there any other further comments or questions from the committee? If not, do we have a motion to approve the recommendation?
So moved.
I just want to make note that if the recommendation is approved by the committee, that we'd be approving it in substantially final form, with the chair of the disclosure subcommittee being authorized to make non-substantive changes to the style and format of the recommendation and its footnotes. Second?
Second.
Second.
Okay. All those in favor?
Aye.
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 In addition to Jennifer, any opposed?
I am.
Who's that?
James.
James. Okay. All right. Everyone have voted? Everyone cast? Looks like it's approved, and for the record, we will note the 2 abstentions, and in particular, Jennifer's split votes on the various components that she mentioned. Thank you, everybody. We'll now turn to the subcommittee and working group reports. I'd like to turn first to our investor as owner subcommittee. Gina Gale, be able to do that subcommittee?
Sure. Thank you, Brian. Good afternoon, everyone. The Investor as Owner Subcommittee, since our last meeting, since our last IAC meeting in September, we have met monthly. So we met in October, November, and right before this meeting. For each of those meetings, we discussed the panel that we hosted back in September, talking through any recommendations that might be flowing from that panel, the panel on developments in securities law. And specifically, we are discussing developing a recommendation around Section 11 in Slack. From our subcommittee as well, we are still having discussions on a potential recommendation with regards to the accredited investor definition. And we've been discussing co-sponsoring panels. Potentially, one of the panels today we co-sponsored with Market Structure on mainstreaming of alternative investments, and we've been discussing other potential panels that the owner subcommittee can either sponsor or co-sponsor for the March or June meeting forthcoming. Since those panels are still under discussion, I don't want to jump the gun naming them, but in terms of forthcoming recommendations from the subcommittee, we do have the Slack recommendation forthcoming, as I mentioned earlier, and we are hopeful that we will be able to come to some consensus around the accredited investor definition recommendation as well.
Thank you, Gina Gale. James, investor as purchaser?
Thank you, Brian. Similar to Gina Gale, Purchaser has met on 3 occasions. It's important to note that the only official member of Purchaser was, in fact, myself. That has changed recently, and with the formation of the new committee, we look forward to participating in the production of a panel discussion for our next meeting in March. Thank you much.
Thank you. Andrew, market structure?
Yes, so following today's discussion about the mainstreaming of alternative assets We will meet as a subcommittee next Thursday to try to think about ways to have a narrow recommendation based on what, a lot of what we've heard today, and try to make some good recommendations that are tailored. I suspect, we've heard a fair bit about registered funds today, and I think we do want to continue to discuss about that piece of it, and while also at the same time making sure that we are thinking holistically about this as the investor as owner subcommittee is thinking about the accredited investor and Reg D recommendation as well. Separately, the market structure subcommittee is still working to finalize by March a recommendation about screening private market investments in countries of concern following our June 2023 meeting on this. And I'd like to thank Paul, James, Brian, Andrea, and others who have offered feedback for this recommendation so far. We wanted to take some more time to incorporate some more of everyone's feedback.
Thank you, Andrew. Christine, for the disclosure subcommittee.
The disclosure subcommittee also met 3 times since our last IAC meeting. Our discussions primarily focused on the preparation for the panel this morning and the recommendation this afternoon. Looking forward, we will meet and discuss whether or not there will be any forthcoming recommendations based on today's panel.
Thank you, Christine. Finally, Paul, Access and Inclusion Working Group.
Yes, the Access and Inclusion Working Group met several times since our last meeting. We focused on the panels that we had today, the arbitration panel and the access to alternative investments and the access and inclusion implications of both of those panels. And then we also focused on the Finfluencer recommendation that we considered this afternoon and the implications there. And as always, we look for our ability to factor in access and inclusion issues in terms of our panels and focus for our recommendations. So that concludes my report.
Thank you, Paul. So that concludes our subcommittee and working group reports and brings us to the end of this meeting. I would like, as always, to thank our investor advocate, Christina Martin-Pavita, as well as Mark Sharma, Adam and Andrew, and the full supporting team of the SEC staff for keeping the IAC running smoothly. Thank you all, and we look forward to having you join us at our next meeting in 2025.